derivatives outstanding. Derivatives is just so far out of everyone's common language in this country because it's a bank speak, if you will, of the super rich and the super wealthy banks. America holds 95%. The top 5 banks in America hold 95% of all derivatives. Derivatives, most of them are based on interest rates, but they're pretty much like bets going to Las Vegas on a whole lot of other things. If you've got $199 trillion, these numbers don't make sense to us because we're working on the $5 bill in our pocket. But if you have a $200 trillion marketplace sitting out there, and you poke a hole in it, and 1/10 of that goes kaboosh tomorrow morning at 8 o'clock, that's only $2 trillion. The banks will keep moving, most likely, except that the rest of us are going to stop dead. $2 trillion out of a $15 trillion economy is one whale of a hit. You realize the housing crisis in the last 3.5 years, the housing crisis has cost us $6 trillion worth of lost home sales, new and used. $6 trillion. Is it starting to make sense why the economy is sluggish? Is it starting to make sense why the government is not helping us? In the near future, obviously the government's going to be facing a day of reckoning. There's going to be a power, an entity, a government rich enough to bail out the United States government. If you've got $100 trillion worth of unfunded liabilities, okay, let's just pretend they don't exist. That's pretty much what the rest of the world's doing, which is fascinating. If you look at the Greek record in the last 6-8 months, we're all kind of familiar with the Greeks. They've had a million problems. Their total indebtedness and their total deficit as a percentage of their GDP is less than ours. So the next question becomes, how come we've not fallen? Well, we've not fallen for a lot of reasons, one of which is we've pumped 300% more dollar bills into the monetary base of America since 2008. October 2008, we had 800 billion in circulation. Today we're closing in on 3 trillion monetary base. I understand a lot of stuff is just way out there. But if you start gathering the idea that that is a 300% increase in the amount of dollar bills in circulation today in 3 years, so roughly 100% a year, obviously. For the prior 40 years, the average increase in numbers of dollar bills in the circulation was 3% a year. So we went from 3% to 100% a year for the last 3 years. I asked Dr. Kolikoff one day, he's a much smarter man than I, why haven't we had 300% inflation then? And he took me back to my Economics 101 class, which basically says you have to have volume of money times velocity of money. Velocity means how much is loaned out by the banks. Okay? Volume of money, so that's that almost $3 trillion we now have in circulation, times the economic impact of banks loaning that money equals inflation. Well, there's a fascinating chart on the St. Louis Federal Reserve's website right now that shows this hockey puck of growth of money. But we have the inverse hockey puck stick going down for the velocity of money. And the net result has been 1 to 2% inflation. Ben Bernanke has not lied on that point. 1 to 2% inflation. That's why he thinks he can still stick more money in the economy and not have any inflationary effect on us. All this is going to come to a big sliding stop one day when the banks start to understand they can actually loan out money to you and me and the local companies and actually make more money at a safe return on investment than they can by keeping the money on stock with the Federal Reserve.